Hello, Michael Shotnik with Sierra Pacific Mortgage, reaching out to talk about a topic that it's very topical these days, and that is inflation, recession, and there's all kinds of content being pushed out around this. But ultimately, I want to speak to how that affects myself as a lender, you as a real estate agent, you're a buyer, and really kind of the core of what drives our business. First and foremost, it's our job to help clients, I believe, create wealth through real estate. Sometimes it's really easy to do it, sometimes it's challenging, but ultimately, how do we kind of frame where we're at right now and understand and be able to communicate with our clients in a way that will maybe ease some fears and then also help us create kind of value and ultimately benefit for our client. So first and foremost, I think we need to understand our clients' fears. And I really think there's two kind of primary fears. Coming out of the 2008 Great Recession, that's still fairly fresh in a lot of people's minds, and or millennials that are purchasing, they saw their parents go through hard times during that recession. So we need to, I believe, specifically speak to that. And by addressing their fears, I think we can do that. First and foremost, I think new homeowners are concerned about timing the market incorrectly and kind of going into a home where they put their life savings in and then immediately losing value, and or buying a home and seeing their kind of cash flow reduce, maybe because of a recession or an income decline, and be put in a position where, via loss of income, they're unable to make payments and have to give the home up via maybe short sale, foreclosure, or something to that effect. Where I think the conversation starts around this is ultimately inflation and kind of what is that? Let's start there. So inflation is too many dollars chasing too little products. And what's led to that is stimulus money being dumped into the market. So that's coming out of COVID. We saw trillions and trillions of dollars pumped into the economy to create spending, keep the economy afloat. And in addition to that, we've seen supply chain issues. So both sides of the equation went to the extremes. And that's where we've seen this kind of rapid inflation result, because again, too much money chasing too few goods. The response is an increase in pricing. And you'll hear kind of the CPI, Consumer Price Index, and that's an annual measurement of inflation measured out kind of on an annual basis, but taken into account month over month. So as we hit a new month, what happens is when we hit early June, we're going to look at May numbers. So we're going to get rid of May 2021. We're then going to average in May 2022 numbers. So we stay on this cycle where we're dropping off a month, adding a new month. So what I think we're going to see is, it's going to feel like we're going to see some leveling out of inflation. But then as we get into the summer months, just based on how the CPI is average, we're probably going to feel like we see another spike in inflation, which nothing's really changed. It's just how the calculation works itself out. In the meantime, we're going to see the Fed continue to raise interest rates, with the idea being really crushing consumer demand without mincing words, to get on top of this and ultimately kind of beat down inflation. Let's put some graphics to this. And here's what the Fed has done during the last handful of kind of building up to recessions. So you can see going all the way back to 1955, inflation, or excuse me, Fed hike, rates increase, saw a recession ensue. Same thing. Fed hikes led to a recession, rates increased, recession, increased, recession. So we're seeing it over and over again, and that's where we're at right now. Is the Fed is forcing rates up. So we're kind of behind the curve here a little bit, but like we see here, rates are going to go up, and then we're going to see a recession. So I do believe we're on a pretty clear path to recession. And another thing worth mentioning here is unemployment rates are extremely low, and that's what we're looking at in this chart. Is low employment rates, recession. Low employment rates, recession. And then coming over to more recent time, low employment rates, recession. Same thing. We see it over and over. So that is interest rates up, recession. Unemployment rates down, recession. So we're heading that direction. And then this is really pretty powerful to look at as well. So when we look at the CPI, that's the measurement of inflation. When we see that go above 5%, which we're about 8.5% right now, there's a 45% chance we'll see a recession within the next 12 months. The trigger here, that happened in Q2 of 2021. So we are kind of at that point where, based on this stat, we may be in a recession. The second stat to layer on here is the unemployment rate. Once that goes below 4%, there's a 42% chance we're going to hit a recession within 12 months. We hit that point Q1 of 2022. And the really powerful one here is once we see these two combined, so inflation above 5%, unemployment below 4%, there's a 100% chance we're going to hit a recession. And that happened Q1 of 2022. So based on history, there's a 100% chance we're going to hit a recession by Q1 of 2022. So what does recession really mean? And again, we have fears that if we go into a recession, we're going to see what we saw in 2008. 2008 to 2012, that was a very different time. What led to that was really artificial demand created by risky lending products. People that had a pulse could qualify for a home, and the products that they were put in were really, really risky products. So arms, balloons, with 100% financing. So the moment the market turned, no one had equity in their home. They had really no options other than give their home up for foreclosure. So we saw this massive decline in housing. However, that's not customary. And let's go to this next slide here. What we generally see through recessions, going all the way back to 1960, is really pretty positive. 2008 to 2012 kind of being that one exception here. Otherwise, housing has really fared really pretty well through a recession. The inflation, interest rates going up, that's painful, but housing is in a really strong place because contrary to 2008, now most people have significant equity in their home, and or if they're purchasing their home, it's common sense lending. So I do not think we'll see a housing collapse through this next recession. And ultimately, that's the silver lining here, is if you turn on the news now, in kind of probably over the next 6 months, you're going to hear recession over and over and over again. It's kind of depressing, but the silver lining here is, housing should really fare pretty well. So when it comes to helping our clients create wealth with real estate, there should be opportunity to do so. There will most likely be a little more demand in the market because of kind of these counter-inflationary measures causing the recession, which is actually an opportunity to help those that haven't purchase, to help those move-up buyers move into another home. So there will be demand and there will be opportunity to help clients and ultimately keep that track record of helping create wealth through home ownership for your clients. Any questions, anything I can help with, please let me know.